Well, here we go, the most popular video series I do on the channel, which is the stocks I'm buying, and today it's the March 2024 edition. So this is a monthly series I've done on the channel for 6-7 years where I talk about the stocks that I am buying. I bought these stocks from the 1st of February to the 1st of March, and I do this video series so you guys know what moves I make in the market, and it keeps all that transparency. Any stock that I buy is always on this video series. Any stock that I sell, or sold should I say, is on this video series as well. So it just keeps all that transparency. I did it through the bear market of 2022, the worst stock market crash since 2008. And any of you guys that saw my videos during that time frame will have seen the stocks that I bought and the rewards that have come from those stocks. Not like those other YouTubers that hide it behind a paywall, or sometimes quietly sell it out in the background, or even disappear totally in the 2022 stock market crash, or even suddenly go from being a stock market content creator to a finance creator. I've stuck here through the bear market and I told you everything that I'm buying and selling, and now we're in a bull market. I'm still doing this video series for you guys. Now I apologise, this video was supposed to be yesterday. It was just a busy day at work, and then I had a football match in the evening, so I never got round to it, but I'm sure you don't mind. It's going to be a bit of a long one. I am going to do my UK version probably on Friday next week for you guys that want my UK stocks that I'm buying. There's a lot more on today's video. I was a little bit more active in the US market in the last couple of weeks. There was a bit of a wobble going on in the market. On the UK side, it was a little bit quieter. So yeah, anyway, I'll drop that on Friday next week. But let's focus on today's video, the stocks that I'm buying March 2024 edition. Hope you enjoy it. Let's get started. Now I am going to point out, just for anyone that's new around here, I am a long-term investor. I buy these stocks and I hold them for around about 3, 4, 5, even longer than that sometimes, years. I keep it to a 5-year range just because it gets a bit blurry after the 5 years, but I could still hold them longer than 5 years potentially if the business is still smashing it. And when I buy these stocks, I actually try and get them for a 100% return. So every stock that you see on this list is that I'm buying it because I believe the stock can return over 100% in the next 5 years. Now before we do start, if you do want to join the Patreon, link is in the description. £5 a month, you can see my live buy and sell alerts on there, and as well as that you get 2 exclusive videos every week on there. So this weekend I'm going to drop 2 exclusive videos for you guys on the Patreon. There's a Discord with 500 members on to talk about stocks, including me, and you support the channel as well for all this free content that I give you guys. So if you do want to join that, link is in the description. So thank you to all the Patreon members that are on there. And if you do want some free shares, join with the link in the description. You can join Trading 212. That's personally the broker that I use. If you join through that link, you can get a free share worth up to £100. And by the way, did you see the other day, Trading 212 have actually now put their APY up to 5.2%. They just keep smashing it, them guys, don't they? Anyway, let's get onto these stocks I'm buying. Number one, let's get this one over and done with, because whenever this stock stays at these sort of ranges, I am buying PayPal. And once again, I did buy some more shares in PayPal in the last few weeks. So the stock is currently at $60. It did actually go a little bit lower after it reported earnings. As you can see here, it did go into the $50 range, and that is when I did buy my shares. And it has had a bit of a recovery since then, but realistically the stock hasn't really done much in the last few months. And if you're looking further out, the stock has been absolutely crushed. Now during 2021, as most of you guys know, we had the CV situation and online transactions went absolutely crazy. PayPal's revenue and financials boomed, the valuation went a little bit overstretched, and then it's had a reality check. Now the thing is this reality check has now gone from, okay, it was overvalued, so now it looks like it is incredibly undervalued in my view, and it's just been massively way sold off. And if you actually look at the share price now, it's actually lower than where it was in 2019, so 5 years of share price has been wiped out on PayPal. Now the thing is with PayPal, everyone kind of refers it to now as it's a dead company. Everyone says it's a bad business, and I just totally disagree. The company is actually doing very well in my opinion. And when you go on to look at PayPal, obviously you've kind of got the legacy business here with PayPal. You've got Venmo. I think a lot of people forget Venmo is a very popular app for people to transfer money to each other. And also I think people don't realize they have Braintree as well. This is one of the major growth drivers of the business. I think in the last quarter it grew something like 30%, and this gives the overview of if a business wants to have a checkout but it doesn't want to have a branded checkout, it wants to have its own checkout to look like you are paying through, let's say, Nike and you go pay through Nike, it looks like Nike's handling all the payments for you. Realistically, Nike can't do that. They're focusing on the shoes, and it's actually going through PayPal. It's just unbranded, so you actually don't see the PayPal name on there. And like I said, people say it's a dead business, and I see anything but that. Fintech seems to be struggling at the moment, and PayPal is joining in that. And I look at the recent financials, and I thought they were absolutely amazing. Revenue up 8% year over year. Once again, you know, people say this is a dead business. At 8% year over year growth, I can name 50 companies that wish they could grow 8% year over year. That's amazing growth. This is one of the things that I never understand with PayPal. Like people say PayPal's dead. Like 8% year over year growth. Total payment volume up 15%. That's really, really impressive. And once you go onto the actual financial report, once again, it looks pretty good from there. Operating income increased 39%. Operating margin expanded as well. They're all pretty impressive numbers when you look at the business. And then when you look at the business itself, I mean, just look at the growth that it's had. Look at the profitability that it's throwing off. It's throwing off around about $4 billion a year, which is really impressive. Pretty decent balance sheet. Sits around 53% debt to equity, which is really nice. And because it's throwing off that much profitability, you've got a company here that's going to buy back $5 billion of its stock. This is on a business that is $64 billion. That is a major buyback on the business. And the big wild card we have here as well is that PayPal have got their new CEO. We've got Alex Chris in. He was at Intuit, did a fantastic job at Intuit as well. And you know, we're looking at the new features that he could potentially bring in to try and maximize that profitability a little bit more, maximize that revenue a little bit more. But realistically, when they're already doing these numbers, I mean, even if he just, you know, slowly drags out an extra couple of % on the revenue basis, maybe a little bit more on the profit basis, even if he doesn't do it, I still think the company's a very good value right now. Never mind if he actually does get it even further down the line, which is the kind of wild card that we have here with the new CEO coming in. And you know, you're picking this company up at 15 times earnings. I mean, on a forward basis now, I think it's about 11 times forward earnings, which is crazy. 11 times forward earnings for a company that's buying back $5 billion of its stock, that's growing at 8% a year. It's, you know, for a brand name like PayPal, and people say competition. Yeah, you know, there's a bit of competition in there with the actual payment side of it and where you use the Apple Pay or Google Pay, but it's not like it's just something that's popped up in the last 2 years. Like, guys, this has been around like for the last 10 years, and PayPal's, even 5 years ago, PayPal, I never saw someone go to the bar 5 years ago and they went, hold on, I'm just going to pay with my PayPal account. I never saw it. So people talk about this as the biggest risk to it, but it's something that I don't believe is a really big thing to PayPal's business. The big thing is supporting businesses. And as long as they can maximize the businesses and the small businesses that use PayPal, that's the key area where they're going to do well, in my opinion. So yeah, I really like PayPal at these sort of levels. The next one on this list is MercadoLibre. So this is a stock I've owned for a while. It was one of those stocks that I prioritized buying in the 2022 dip, and it has done very well for me since I did start buying during the 2022 dip. I started buying my shares around $700, which actually I would be up over 127% on, but I really like this business, so I just keep buying more, and I keep averaging up. If I ever see a dip that I go, I don't think it should have dipped on there, I'm going to buy more shares in it. So I'm trying to make sure I'm watering the flowers and trimming the weeds, or cutting the weeds, not trimming the flowers and watering the weeds. I'm trying to buy my very good performers and keep adding to them. And that is MercadoLibre. Now, I did not expect it to be on this list, but there was a drop off earnings, which I didn't think should have happened, as you can see here. So with it dropping off earnings, I did buy some more shares. Now, MercadoLibre is an e-commerce platform, as you can see here, and also it has a payment platform as well, which is Mercado Pago. So you're basically going to get Amazon of Latin America, and you're also going to get PayPal of Latin America. E-commerce is growing rapidly, and as well as that, the payment side of it is growing rapidly as well, with the infrastructure in place to use e-commerce, and MercadoLibre supports both of them. Now the great thing with payments is the higher margin, so we have the kind of lower margin e-commerce business and the higher margin of the payment business. And also there's other segments in the businesses as well, like advertising and lending, which are doing very well as well. Now when you look at the fastest retail e-commerce countries at the moment, you can see that there's a lot of Latin America in there. You've got the likes of Argentina, for example, Mexico, for example, but obviously there's other countries in there that are also growing rapidly as well, like the likes of Chile, for example, Brazil, for example. So there's a lot of fast growing countries in Latin America. So they are quite well diverse, and that's leading them to do excellent financials. The revenue was up 42% year on year, and on an FX neutral basis, it was up even more than that. You can see total payment volumes were up 57%. On a year-on-year, on an FX neutral basis, was 153%. On a gross merchandise volume, was up 39%, and on a year-over-year basis, up 79%. That's very good. So if that FX impact can calm down a little bit, these numbers are going to look even better. Now, from an EPS point of view, it was a beat. However, they did have to take a one-time charge, which seems the reason why the market freaked out on their latest earnings. You can see here they actually came in with a $3.25 when you take in the tax impact. If you take out the tax impact, they actually beat by a fair amount. It was something like $7.29 or something. So it was a really good beat on the EPS, but for some reason, the algos more than likely picked it up and sold the stock off, which is absolutely crazy. So given that the financials are absolutely smashing it, there seems no slowdown in payments, in e-commerce in Latin America, and it's traded at 54 times earnings. If they're doing these sort of growths, I think this is a very fair valuation for this business. So I added in a little bit on the dip. The next one is InMode. So InMode is a stock I've owned for around about 4 years now. I first started buying during June 2020. Since then, the stock is up a fair amount. But once again, I keep adding into my best performers. Now I say best performers, this stock was actually a stock I was selling out at 300-400% during 2021, and then the stock has been coming down since that. I thought eventually we would see InMode start rallying up, but it hasn't seemed to be able to recover since, and now it's traded all the way down at 9 times earnings. Now when you look at InMode, they are a company that sells these expensive devices that do treatments on appearance. Now, obviously, everyone's getting a little bit more conscious about the appearance, and at the same time, people are less willing to get put to sleep, go under the knife. So InMode have created these products that are able to help people's appearances, and they don't have to go under the knife, for example, which is good for the more conscious about appearance, but also people that don't want to have that long day of treatment. You know, they want to go in and then they want to go out. That's what people want to do. You can see they have all these devices like Morpheus, for example, that can change the appearance on a before and after basis, as you can see here. Now, obviously, the big thing is these devices that they sell to these providers are quite expensive. Now, what we've seen is anything that's high interest rate sensitive has been affected this year because the interest rates have gone up. So when you look at InMode, for example, they have been affected in the last couple of quarters as interest rates have been going up, and you can see the growth has been slowing. So in my opinion, InMode is a company that is suffering because of the high interest rate environment. As soon as the interest rates start going down, which I believe will start happening this year, I believe InMode will actually start recovering on a sales basis as financing comes cheaper for their products. And I think this is a good opportunity at 9 times earnings that I would never have expected to see a few years ago, considering the financial performance that they have had, because they've absolutely smashed it. If you look at the recent quarter, it was a decent beat. Revenue was down 5%, but it was a beat. But the thing with InMode is that even though it's a really tough time, the revenue is pretty much hanging on. And if you look at the profitability, they're not having to discount that much. So even though they're not discounting that much, they're actually still throwing off 204 million. Now, when you're a company valued at 1.9 billion, that gives you an extremely cheap valuation. And if they are to go back to growth after this high interest rate environment goes, then I think this is a very, very good valuation. And because of that, they also sit on a very good balance sheet. There's no debt on there. And they currently sit on 741 million of cash. So yeah, half the market cap is nearly in cash. And by the end of this year, it's probably going to be towards $1 billion in cash. Now, this is where some of the biggest criticism of InMode has come, that people say they sit on too much of a heavy cash balance, which I agree. Now, a few people have been saying that they should do a share buyback, But if you listen to InMode's management, they've said that we don't agree with share buybacks because we have done them before and we've not seen the reflection in the share price. They're holding the cash back to do a acquisition. So I think we'll see InMode make an acquisition in the next year. And as well as that, obviously that will probably mean a jump up in the revenue and they should get more rewards from a financial basis as long as the acquisition is also right for the longer term. So yeah, I think that InMode, as soon as we pass this high interest rate environment, they will go back to growth. And if they carry on the growth and profitability they do, I think 9 times earnings is a very fair reflection. So the next stock on the list is Fiverr. So I have recently started a position in Fiverr, and I feel like Fiverr is one of those stocks that gets just thrown in the basket of it was only a CV stock. It only did well because of the CV situation. People all started working at home. Businesses wanted people that were working at home to do work for them without having to take the risk of full-time contracts with the environment that we're in. And we saw a big boom in the revenue and profitability. The share price went crazy, the valuation went crazy, and then since then it's crashed. And it's been thrown in the basket of, it will never be a good business again. And I disagree. I look at the business now and it's taken all the hard comps out of the way. Financially, it's moving back in a good direction, and I feel like the valuation is a quite a fair reflection for Fiverr right now. And if you look at a lot of businesses like using freelance now. It saves them having to take on someone full time and pay the cost of, say, 5 days a week, or having to get rid of them. If they want to get rid of them, they just go, yep, we don't want any more work from you next week. So businesses like using freelancers. They can choose who they have, how much they pay, if they want them or if they don't want them. And people, since the whole CV situation, like working freelance. People like picking what work they do, how long they work for, how much they get paid for that job, which has all led to a growing freelance economy that I think will continue to grow. If you go on Fiverr itself, you can see some of the products, for example, so I can get the likes of a thumbnail made on YouTube for me if I wanted to. But Fiverr, listening to the recent conference call, is actually moving away from simple projects. They're actually trying to move towards the more complicated projects, which ultimately would lead to higher projects, higher costs, but also Fiverr would actually take more money. So it seems like Fiverr is actually now transitioning into more of a competitor to Upwork, which should do them very well because that is actually their fastest growing area at the moment. I think that grew 30% in the last quarter. Now, if you look at Fiverr, the recent earnings were actually not too bad at all. They beat on an EPS point of view, which is the key thing because we want to see them ramp up the profitability. And if we look at the moment, it's trading at 10 times forward earnings, which I think is a good valuation because of the ramp up in profitability. And the revenue is growing at 10%. Now, I think 10% growth for a 10 times earnings is actually, absolutely fantastic. Now, the disappointing thing with Fiverr is they did take their guidance down. They blamed it on the macro environment. But if you do look at analysts at the moment, they are still expecting 6% growth this year, and then they are expecting a ramp up if the macro environment improves next year up to 11%. Now, I'd at first forecast this to grow at 10+% a year, which at 10 times forward earnings, I thought is a really good valuation. Now, I have changed my model to a little bit more growth now, and I think that recently I didn't mind buying Fiverr under $27. Now, the stock has dropped off these recent earnings, and I've got to say, with the drop off the recent earnings, it does actually now factor in lower amounts of growth. So if the business was to still grow at like 6-7% this year, I actually think that Fiverr at $22, $23 is actually a pretty good valuation at 10 times forward earnings for a business growing at 6%. So I think you're going to get access here to a business that is going to take their EPS up in a good rate, the revenue up in a good rate, a good valuation with a fast growing freelance market. So yeah, I do like Fiverr at this valuation. Next one is Alibaba. So I did buy some more shares in Alibaba. I just keep nibbling at Alibaba every so often because even though there's risk associated with Chinese stocks, there's just part of me that goes, I've just got to buy at these levels because even if you put a risk in and you put it at a lower valuation because of the political risk there, I still think Alibaba is a good valuation with the risk associated. Now, obviously, Alibaba own many companies in China. If you ever were to move to China, if you were to live in China, you'd realize you would use multiple products in China. And the Chinese economy has had a tough patch at the moment. They've been a lot more on the lockdowns still, and it's only really just starting to open up. And also, China itself as a government are trying to stimulate the economy more and get it back to growth now. So hopefully with a rebound in the economy in China, and opening up economy, we should see some of these companies do very well once again. And we should see them become more attractive to international investors. And if you do look at the recent earnings, we are seeing the signs of that improvement happening. EPS was a beat, revenue was a beat, and we were back up at 5% year-over-year growth. Now, I would like this to be a little bit higher going forward, but it's still not bad growth, especially when you look at the company and it's currently trading at 8 times forward earnings at the moment. And when you dig into the business, it would be good to see the Tobayo and Tmall group service revenue grow a little bit faster, and obviously that's the biggest segment as well. But there's a lot of good highlights inside the business. Chinese commerce wholesale was up 23%. Cloud is once again one thing that I would like to see growing a little bit faster going forward, but international commerce retail was up 56%. International wholesale up 8%. The whole Alibaba International Digital Commerce Group up 44%. If you look at the logistic network they're building up, was up 24%. Local services up 13%. Digital media and entertainment group up 18% as well. So there's a lot of growing sectors still at good rates here. I would just like the cloud and the Tmall parts of the business to go on a little bit more growth. But if China starts supporting their economy a little bit more, it will start happening. So yeah, even if the growth doesn't get to where I hope it for, I think I'm not really going to, I think at 8 times earnings, I don't know if I can really lose money on this one right now. And we're starting to see the revenue growth start coming back to the business. We're starting to see them throw off good amounts of profitability as well. Balance sheet wise as well, it's a pretty decent balance sheet with this one. And when you look at the valuation, like I said, it's currently around about 14 times earnings. On a forward basis, it's around about an 8 times earnings. And this is historically the lowest it's ever been. And obviously when you look on the share price point of view as well, I think the share price is the lowest it's ever been since even its IPO. If I go back here, yeah, it's down 20% since its IPO in 2014. So a decade of share price gains actually wiped out on this. And obviously it throws off a good amount of profitability as well. So because it throws off so much amount of profitability, they're actually now buying back, a ton of shit. They're trying to get those international shareholders back into it. So they're actually buying back an additional now. They added on another 25 billion buyback. And even once again, to try and get those international shareholders back in, it's actually then announced an annual dividend as well, just to try and attract the shareholders like, hey, look, we're trying to support you here. So I think Alibaba's trying to do the right things. I think the Chinese government have kind of woke up now and gone, we need to stimulate the economy a bit more. So I think the valuation here to the risk is definitely worth it, and I just keep every so often have a point where I nibble at Alibaba, really. SoFi, so I did buy some more shares in SoFi. Once again, I didn't really expect to buy more shares in SoFi, but the opportunity came up, so I did buy some shares in SoFi. Always seems a volatile one, seems a very shorted stock. There's a lot of shorts put out here, which put a lot of fake news out there. So there always does seem to be that opportunity because of that. SoFi basically reported earnings. The stock did really well. Like the stock was up 20%, as you can see here. I was there going, oh, that's absolutely amazing. That's SoFi going on a good run now. And then within like the next 2 or 3 days, the stock literally gave all the gains back. And I mean, is this like the 3rd time I've said this exact same piece where they've had to pop off earnings and then they give them all back? And I was like, right, if you give me SoFi back in the $7 range, $7.50, I like buying it under 7, but I went, you know what, that's crazy, I'm going to buy the dip here, and I did buy the dip in SoFi. It has once again, like the last couple of times, then gone on to recover once again from the drop, so yeah, strange move from SoFi there, but I think it's a lot to do with the shorts at the moment and they're playing the games, but hey, they're giving me opportunities to buy. SoFi, a bit of a disruptor into like the banking finance space where you can get all these products at good rates all in one place and breaking that kind of traditional banking method of those physical locations, and obviously that leads to more profitability in SoFi. The recent numbers from SoFi were very good, growing 34% year over year. The guidance were very good. They hiked up the EBITDA guidance a lot higher than what was expected. Yeah, really good numbers from SoFi. The next stock was DLocal. So this is probably going to be the last time I buy DLocal until I get the next earnings now. This is once again a relatively new position that I've started adding into the portfolio. It's currently 36 times earnings and I think it's 20 something times earnings on a forward basis, which I think is a good valuation for the growth that you are getting here. DLocal is a fintech platform that helps people or businesses, and you can see some of the customers down here like Nike, for example, Booking.com, Zara, Temu, Amazon, Shopify, Microsoft. They've got a lot of big clients here. Basically, if they want to start doing transactions in more higher risk markets like Africa, Asia, Latin America, they take a lot of the payments for them. They manage the risk, they change them into the currency, they manage fraud for them, and they take a cut from that. So they are doing very well in these hot growing spaces and taking the payments for them. Now, if you look at the recent earnings looked okay. I'll say okay on a growth basis, they were really good, but on targets they did miss slightly on an APS, and revenue they did miss slightly by 2 million, and the revenue was up 46% year over year. So like I said, they look like it missed on the numbers, but 46% year over year growth is still, pretty impressive, isn't it? But when you actually start digging into numbers, you actually see how impressive those numbers are, because total payment volume was actually up 69%. And if you look at EBITDA was up 34% year over year. Now, one of the big impacts they actually had in this quarter is currency impacts. Now, you've seen that with MercadoLibre, for example, but they were hit by an extra financial impact because, like I said, they don't just operate in Latin America, they also operate in Africa. And that also gives them exposure to Nigeria. Now, if any of you guys that own Airtel Africa, you will see the impact from Nigeria at the moment because their currency has been devalued massively. So there is currency impacts going on at the moment. DLocal itself is trying to reduce the exposure here because it represents 20% of their total revenue, down from 29% as well. And if you see, excluding Nigeria, the Africa-Asia range actually grew 79% year over year. So you look at these numbers here and you think, if it wasn't for that Nigerian impact, imagine the beat that this company would have had on these numbers. And you can see here that excluding the Nigeria impact, revenues would have grown 58% year over year. So you look at these numbers now, 46% growth without that impact, 58% growth. Imagine the beat on these earnings it would have had from an EPS point of view and a revenue point of view. That's absolutely crazy. So overall, if you zoom out and you actually look at the numbers, the growth has been impressive and the profitability growth is still impressive at the moment. And because obviously as a fintech platform, they have high margins. That's thrown off a lot of profitability. Means they have a really good balance sheet as well. Yeah, I really like DLocal. There is a risk there elements because of the currency impacts, but yeah, I do like a bit of DLocal here. And the next one's Walgreens. So I'm buying this as a turnaround play. It's a company that's been mismanaged, and I'm hoping that they can get a new management team in and turns the business around. So if you were to look at this article here on Seeking Alpha, this is basically a sum up of what the business is trying to do. They're trying to drive up the profitability that they have inside the business by using the stores, opening up more online sales online, and hopefully bringing in a new CEO that then turns the business around. And when you're a company like Walgreens, you only need a little bit of cost cutting in place to then move into a place where you are a good valuation and throwing off decent amounts of profitability. You look at the company now, if we look at analyst forecast, they're expecting 6 times forward earnings, and then obviously if you can collect a nice dividend, that's really good. And an 18 billion market cap, if they can get to some formal level that they used to do on a profitability basis, where they get to 3 billion a year in profitability, 4 billion in profitability, that's not bad on an 18 billion valuation as well. And as well as that, they're selling off other parts of the business that they don't really like. That's strengthening up the balance sheet. That was a bit of an issue a few years ago. Obviously you can see here they've got the debt to equity down now to 33%. Yeah, I'm buying this as a turnaround and hoping the cost cutting can come in place and drive up the profitability. Balance sheet's getting a little bit stronger. I'll collect a dividend and the share price will go up a little bit from here is what I'm hoping for. So yeah, I did buy Walgreens. That's a bit of a turnaround play here. And the last stock I bought was Evolution. So I did buy Evolution. I stick this on my US portfolio because of its dual listing. 24 times earnings, 2% dividend yield, and the stock has been on a bit of a run since I have been buying it. What they do is they provide online casino games, and if you actually were to look at some of their clients, if I can have a look down here. Yeah, so they've got some of the clients down here like William Hill, Betfair, 888 Casinos, The King, they've got The King in Tain, I'm sure they've also got Paddy Power, Flutter. Yep, so they've got all these big clients, and these kind of companies here, they don't want to have to manage all the games that they provide. They go to someone like Evolution, they provide the games, and then Evolution just take a cut of the game. So it works for everyone. And as we know, we've got a fast growing online iGaming at the moment in the likes of Latin America, the US, we've covered that multiple times on the channel with DraftKings, Asia as well. So they've got exposure to worldwide coverage, which is a little bit different from DraftKings that gives me coverage into just the US market. This gives me coverage into the whole world and multiple clients as well. Bit of a picks and shovel play. And if you look at the recent numbers as well, the recent numbers were very good. Revenue was up 23%, EBITDA up 25%, very good. And you can see here the breakdown from all the countries they have with Europe, Asia, Latin America and other, as you can see here, which is pretty good, and they have 40% of the regulated market, which is pretty impressive. And yeah, really high margin business. If you look here, the growth is very good, the profitability of the growth is very good, and leads to a very good balance sheet, and also you collect that nice dividend yield as well. The biggest threat that has with Evolution Beauty is that when you have a company that's growing this much in this profitability is competition. That's the only thing that I ever worry about. Evolution is competition, with the likes of Playtech, for example, coming in. You would expect some form of competition, but ultimately I guess the big thing is that because they have such a good reputation and a lot of these businesses are seeing such success from using Evolution, you know, I think it would be very risky for them to move away from them if they're seeing the success. So I guess that's kind of the moat, is the reputation that they have at the moment. So yeah, I did pick some Evolution up. And then we get onto the sell-ins. So I did sell 2 stocks during the 1st of February to the 1st of March. The first one was Hims, so don't worry, I didn't sell all of Hims, but as you know, it's had a cracking month. The stock has been up massive, it's up 47%, and I did decide after their really good earnings that I am going to trim the position. I trimmed the position by 5%, meaning I took a 115% gain from Hims, and that was just to protect it from a massive jump. Now obviously I still think Hims will go higher in the next 3, 4, 5 years, and that's why I still hold a mega amount of shares still. It's because I do believe it was higher. I just protect myself, and a few people go, well, why are you doing that if you believe it goes higher? Well, I'll show you in a perfect example here. During 2023, the stock went up to $12. I sold off 10% of my position during that time frame. And people went, well, why are you selling it if you think it's going to go higher? So share price has just gone up too much. You never know. It might have a bit of a pullback. Let's take some profit off the table. We're all here to make make profit, sorry. And since then, the stock unbelievably went down 51%. It made no sense why it went down, but that's the stock market, guys. Them sort of things happen. And everyone that got up to $12 and then saw the stock go back down 50% went, oh, I wish I took some profit off the table. And I did. And then I was able to buy back in at $6 only a year ago, and then we've gone back up again. So just repeating the cycle once again. And at the end of the day, you know what? If it doesn't go back down $6 this time, guess who's still got 95% of their position still there? Me. So I win either way, and that's the key thing, guys. The next thing is TDoc. I did get rid of TDoc. I saw their recent earnings. They were absolutely atrocious. They did beat on EPS, but revenue, yeah, it's down. Well, it's up 3%. They did miss by a decent amount, and it was only 3% growth. The guidance was pretty poor, and it's just not growing into what I hope it would. The profitability just isn't ramping up as much as what I hope it would. It's not a terrible business because it does still throw off some free cash flow. It's just nowhere near ending what I want it to do. And I just thought, is there any point having the money in here, or could I go buy another business? And I thought, I'm going to go buy another business with the money that I have in here. So I did sell out of my TDoc position. And ultimately, like I said, you know, the last kind of 2 years, what I've been focusing on, I've kind of thrown TDoc under the bus. I've gone, you know, the management team were happy with these results, and I'm like, they're awful. Your market share's been absolutely awful. They're not executing, and my focus has been on Hims. You know, Hims is the stock that I've kind of been buying massively in the last 2 years, and I've always said, like, whenever I talk about TDoc, I go, I can't buy any TDoc because why waste money on that when I've got Hims absolutely smashing it? So TDoc's kind of suffered because of another stock I own, which is Hims, and Hims has absolutely smashed it. So yeah, I did the right thing of allocating into the business that was financially performing, and obviously Hims has done that. So even though Hims has been one of the main reasons why TDoc has been absolutely crushed, it's financially being the right decision to be focusing on that one, which is the main thing anyway. So yeah, those are two moves that I did make on the selling side anyway. So a bit of a long one, guys, wasn't it? Hope you enjoyed it anyway. I'll see you on Monday. Unless you're on the Patreon, I'll see you in a bit, guys. And I definitely need to go get a cup of tea or something because my voice is absolutely gone after this video. Hope you enjoyed it, guys. See you in a bit.